A warm welcome to all my students. Today we will study about public finance and budget. In this chapter you will learn about meaning of public finance and its importance, budget, public expenditure and public income, deficit, finance and fiscal deficit. So these are the topic we are going to discuss in this chapter. In the previous session, we had learned about the meaning of public finance and its importance, budget, public expenditure. So these are the topic we have discussed, and now we will start with the public income, deficit, finance and fiscal deficit. So these are the topic we are going to discuss in today's session. Before starting with the direct tax, let me discuss what we have learned in the previous session. In the previous session, we had learned about the public revenue. Public revenue may be released from taxation or from non-tax sources such as revenue from the government-owned corporation, public wealth funds, grants, etc. And we will be discussing the source of revenue of central government. The central government collects its income from various sources, and those sources can be classified under two heads as revenue and capital receipt. Revenue receipt. The revenue granted by the government through tax and non-tax source is called revenue receipt. Revenue receipt comprise revenue from tax and non-tax sources. Tax revenue. Under tax revenue we learn that tax is described as a compulsory payment by a citizen to the government without expecting any direct benefit in return. And central government imposes several types of tax. The government imposes higher rate of tax on high income group and lower rate of tax on lower income group. The poor are exempted from income tax. Similarly, a higher tax is imposed on luxury goods and service used by the rich, and a lower tax on goods and service used by common people. This is called progressive tax. In the previous session, I have taught these topics. Now we will continue with the next. The tax imposed by the central government are of two types. The taxes imposed by the central government are of two types. First one, direct taxes. When the tax is paid by an individual on whom it is levied, it is called direct tax. The burden of this tax is not transferable to others. So remember, a direct tax is paid by an individual on whom it is levied. He cannot transfer the tax to others. He has to pay the tax. Important direct tax are personal income tax, corporate tax, stamp duty. So these are the three different types of direct tax: personal income tax, corporate tax, stamp duty. Second one, indirect taxes. If the burden of tax imposed by the government is transferable to others, it is called indirect tax. So as I told you in direct tax that he cannot transfer. Here it can be transferred to others. So we call it as indirect tax. Generally, indirect tax are imposed on goods and services. For example, the government imposes tax on manufacturer of goods and service at that time of producing such goods and service. Indirect tax. We will learn with an example. The government imposes tax on the manufacturer of goods and service at the time of producing such goods and services. The manufacturer transfers this burden to the traders. The trader transfers this burden to the consumer. This means that if the government imposes tax on the producer, the tax is ultimately paid by the consumer. That is, the tax was imposed on the manufacturer. He will transfer it to the trader. The trader will transfer it to the consumer. So first it was imposed on the manufacturer, then it was transferred to the trader, then it is to the consumer. So ultimately who paid the tax? It was the consumer. So this we call it as indirect tax. The main forms of indirect taxes are central excise duty, value added tax, import-export taxes and service tax. These are the different types of tax. Central excise duty, value added tax, import-export taxes, service tax. However, this effect from 1st July 2017, a single goods and service tax has been introduced, and that is GST, which you call it as goods and service tax. Non-tax revenue. Apart from taxes, the government gets revenue from other sources. This is called as non-tax revenue. So we started with non-tax revenue. Apart from taxes, the government gets income through other sources. That is called non-tax revenue. The main types of non-tax revenue are profit earned by the Reserve Bank of India, profit generated by Indian Railways, revenue generated by the Departments of Post and Telecommunication, revenue generated by the public sector industries, revenue generated by coins and mints, various types of fees and penalties, etc. These are the main types of non-tax revenue. A profit earned by Reserve Bank of India, profit generated by Indian Railways, a revenue generated by Departments of Post Office and Telecommunications, revenue generated by public sector industries, a revenue generated by coins and mints, various types of fees and penalties. So these are the main types of non-tax revenues. Now we will start with capital receipt. The capital receipts refer to those receipts which either creates a liability or cause a reduction in the asset of the government. Capital receipts. Capital receipts refer to those receipts which are either created a liability or cause a reduction in the assets of the government. You can understand better with this example. For example, borrowings lead to an increase in the liability of the government. Similarly, receipts from sale of shares of a public enterprises lead to reduction in assets of the government. Hence, they are called as capital receipts. The government generates capital revenue through other sources too. It withdraws its investment from its own industry. This is called disinvestment. The government has invested its money in its own industry, that is public sector. It has invested the money in the public sector. When it withdraws those money, that is invest money, when it withdraws the invest money, we call it as disinvestment. From time to time, the state government repay the loans they have taken from the central government. The state government had borrowed the money from the central government, so they will repay it to the central government. Now we will start learning about the public debt, that is loans. The government borrows money from internal and external sources. The loan obtained from citizens of the country, banks, financial institutions and industries is called internal debt. That is within the country when you borrow the loan. That is from the citizen of the country, banks in our country, we are talking about in our country, banks, financial institutions and industries. We call it as internal debt. The loan obtained from foreign governments, foreign financial institutions and international financial institutions is called foreign or external debt. Now we started with public debt, that is loan. We are talking about loan. There are two types of loan. One is internal debt and external. When the government borrows the money within the country, we call it as internal debt. And the sources are, they can borrow it from the citizen of the country, or from banks, or from financial institutions and industries. When the loan is obtained from foreign governments, foreign financial institutions, international financial institutions, we call it as external debt or foreign debt. Now we will learn about deficit financing. In developing countries, public expenditure is usually higher than public revenue. When I taught you about the budget, I told you we have deficit budget. That is where expenditure is more than the revenue. In developing country, usually we follow expenditure is more than the revenue. So here, in developing countries, public expenditure is usually higher than the public revenue. And this is good for the development of the country. Why do we follow this? It's mainly for the benefit of our country. That is for economical benefit of our country. In order to fill any gaps between its income and expenditure, the government raises the loan from internal and external sources. In the beginning I told you, expenditure is more and revenue is less. That means income is less, expenditure is more. To fill this gap between income and expenditure, the government will raise the loans. It may be internal loan or it may be external loans. Governments resort to various measures to cover up this deficit in expenditure over revenue. Usually borrowing from the central bank, that is RBI of the country, or by printing additional currency. Thus, deficit financing is defined as financing the budgetary deficit through loans from RBI and creation of new money. So, government to fill the gap between expenditure and income, what they will do is they will borrow the money from the central bank, that is from RBI, and still there is a shortage of money, they will print additional currency. So deficit financing means financing the budgetary deficit through loans from RBI and creation of new money. The four concepts of deficit are used and are calculated as shown below. The first one, physical deficit. The excess of government's expenditure over its revenue and non-debt capital reserve is physical deficit. It is calculated as. So here we will calculate the revenue receipt plus non-debt capital receipts and minus the total expenditure. Then we get this physical deficit. Whatever we have collected in the revenue receipt and non-debt capital receipt will be added together and it will be minus with total expenditure and you get physical deficit. Revenue deficit is excess of total revenue expenditure of the government over its total revenue receipt. So here expenditure will be more and income will be less. It is calculated as revenue deficit. Revenue receipt minus revenue expenditure. To know about the revenue deficit, revenue receipt minus revenue expenditure. Third one, primary deficit is defined as physical deficit of current year minimize interest payments on previous borrowings. It is calculated as deficit minus interest payment. You get primary deficit. Primary deficit means a deficit of a current year minus interest payment on the previous borrowings. It is calculated as physical deficit minus interest payment. Fourth one, budget deficit is the overall gap between revenue and expenditure during given year. The gap, we are trying to find out the gap between the revenue and the expenditure. It is calculated as budget deficit total revenue minus total expenditure. It is calculated as total revenue minus total expenditure to find the gap between revenue and expenditure. But high amount of deficits are not good for the economy as they create liabilities, and uncontrolled deficit also indicates financial indiscipline on the part of the government. It also increases inflation. That is why, to check such practices of the government, the Fiscal Responsibility and Budget Management Act was passed in 2003. It seeks to instill financial discipline, reduce fiscal deficit, improve macroeconomy management, and overall management of public funds by moving towards a balanced budget. So, too much of borrowing is not good for a country. That is, high amount of deficit are not good for the economy as they create liabilities, and uncontrolled deficit also indicates financial indiscipline on the part of the government. To check this, government had introduced Fiscal Responsibility and Budget Management Act in the year 2003, and main intention is to instill financial discipline, reduce fiscal deficit, improve macroeconomy management, and the overall management of public funds by moving towards a balanced budget. Today's assignment. What is meant by public finance? Dalton says, concern with income and expenditure of public authorities with the adjustment of one to the other. What do you mean by budget? The statement of estimated income and expenditure of a year prepared by the government is called budget. Budget means the statement of estimated income and expenditure of a year prepared by the government is called budget. Third question. What types of tax are imposed by the government? You have to write regarding the direct and indirect tax. The direct tax and indirect tax. So you have to explain about the direct tax, where the tax is paid by an individual on whom it is levied. It is called direct tax, and give the example: personal income tax, corporate tax, and stamp duty. So these you will write, and next you will explain about the indirect taxes. If the burden of a tax imposed by the government is transferable to others, it is called indirect tax, and explain it with the example: the government imposed tax on the manufacturer of goods and service at the time of producing such goods and services. The manufacturer transfers this burden to trader. The trader transfers this burden to the consumer. So this means that if the government imposed tax on the producer, the tax is ultimately paid by the consumer. And he will give the example of indirect tax: central excise duty, value added tax, import-export taxes, service tax, and he will explain about GST, which was introduced in the year 1st July 2017 as a single goods and service tax. Now next question. What is deficit? Mention the types of deficit. So here remember, you will explain about the What is deficit? First give the definition of the deficit here. Okay, after giving the definition, you will explain about these four, that is the four concept of deficit. First one, physical deficit, excess of government's expenditure over its revenue receipt and non-debt capital receipt is called physical deficit. It is calculated as revenue receipt plus non-debt capital receipt minus total expenditure. The revenue deficit is excess of total revenue expenditure of the government over its total revenue receipt. It's calculated as revenue receipt minus revenue expenditure. Third one, primary deficit. It's defined as physical deficit of current year minus interest payments on the previous borrowings. It is calculated as physical deficit minus interest payment. And the last one, budget deficit, is the overall gap between revenue and expenditure during a given year. It is calculated as budget deficit is calculated as total revenue minus total expenditure. I have explained about the assignment. Thank you, children. In the next session, I will start a new lesson. Thank you.